Are you struggling with the CPA exam because your course failed to fit your learning style? I'm Darius Clark of I-75 CPA Review, where the right teacher makes all the difference. All right, let's look at installment sales. When do you use the installment method? The installment method applies to sales at a gain, not losses. If the property sells at a loss, all the loss is recognized in the year of sale. But if the property sells at a gain, the benefit of the installment sale is that the taxpayer can pay tax only on what is collected in cash this year and defer the gain based on what cash is yet to be collected. So here's an example of the installment method and why installment sale rules exist. We got Cal sells his land to Manny for $300,000 in year one. Assume Cal has a basis in the land of $50,000, and so that means he has a gain of $250, right? Because the basis is $50,000 and he sold it for $300,000. Why should Cal pay taxes on all $250,000 of gain in year one if Manny is only paying Cal, let's say, $25,000 in year one and promising to pay the balance of $275,000 over 10 years in installment payments? Right? If Cal got all his money in year one for the sale of the land, then there would be no need for the installment method rules. But Cal's going to report this sale using the installment method because he has to wait several years to collect all the cash. And what if he never gets the cash? So the installment method is a good cash basis method that allows a taxpayer to include in income only what's collected in cash. So if Cal receives only $25,000 this year, how much taxable income does Cal have from the sale of this land, which is supposedly selling for $300,000? The gain looks like $250,000, but he's only getting $25,000 of the $300,000 this year. He's got to wait 10 years for the other $275,000. Why should he pay all tax on that $250,000 of gain in year one when he's only collecting $25,000 of the cash? What if he never gets the rest? So what the installment method allows him to do is to calculate the gross profit from the sale, which would be the $250,000 total profit, divided by the $300,000 contract price, and that's 83.33%. So your gross profit percentage is important, 83.33, and then see how much cash was collected in the year of sale. And $25,000 was all that was collected, they told us. So multiply that times 83.33%, and here's the taxable income for Cal in year one, $20,833. And that would all be Section 1231 gain. So $20,833 is a Section 1231 gain for Cal in year one, but Cal can defer gain on any cash that hasn't been received yet. Okay, so that's the year of sale. Now, if $100,000 more is collected in year two, then you would take the $100,000 collected in year two and multiply by the same gross profit percentage, 83.33, and 83,333 would be your Section 1231 gain for year two. So you could see a question like this. In year one, the Thompson Company owns land with a cost of $40,000 that is sold for $50,000. So right away you see a $10,000 gross profit. And right away you can divide the $10,000 profit by the $50,000 contract price, and you get a 20% gross profit percentage. Very important. Calculating that gross profit percentage. Because what do they want to know? Ignoring interest income, how much taxable income is recognized in year one and also in year two? Well, that's going to be based on the cash that's collected. They collected $5,000 cash during year one and another $15,000 during year two. And we calculated that there's a 20% gross profit percentage because we took the $10,000 profit from the sale and divided it by the contract price of $50,000. So now just take the 20% gross profit percentage, multiply by 5,000, and you have $1,000 of taxable income in year one. So that means we can eliminate choices A and B. And then for year two, what we collect? 15,000 multiplied by 20%. We have a $3,000 taxable income in year two. So the answer is D. The gross profit on the sale is $10,000. It's the $50,000 amount realized minus the $40,000 cost. And then we calculated the gross profit percentage, the 10,000 gross profit divided by the 50,000 contract price. Now in the third step, we saw how much cash was collected and we multiplied that by the 20% gross profit percentage. Now remember, the problem says ignoring interest income, right? Well, what's up with the interest income? If you have more than a year to collect on payments that are owed to you, there's going to be interest in the question. But the good news is with installment method, the interest income does not enter into the calculation of gross profit. Interest income would just be additional income, ordinary income, recognized by the seller as payments are collected. So even if they give you information about the interest, you can ignore the interest if they ask about the gross profit percentage. You got to calculate the gross profit percentage without regard to the interest. And the interest income is all recognized as income without regard to the gross profit percentage. So if there was interest and they told you they collected $200 in interest on top of the payments, so let's say in year one they collected $5,000 in cash plus $200 of interest, then the $200 in interest you would not multiply times the gross profit percentage. That $200 of interest, all that is interest income. It's the $5,000 in cash apart from the interest, that's what you'd multiply times the gross profit percentage. But you see how the question says ignoring interest income? That'll probably be the way it'll be on the exam because they don't want to confuse you with the interest. There's enough going on in these questions where they don't have to mix the interest in. It gets a little more sophisticated when there's a mortgage on the property being sold and the buyer is assuming the seller's mortgage, because the seller is getting debt relief in addition to the cash. And the exam will ask, how does that debt relief impact the total gross profit on the sale? And how does that debt relief impact the gross profit percentage? So let's look at this one. In year 21, a taxpayer sold real property for $400,000, receiving $200,000 at the closing and $200,000 plus accrued interest at the prime rate in the next year. Now, what do they want? It says if the transaction qualifies for installment sale treatment, what is the total gross profit on the sale? So while the sale price is $400,000, look what it says in this sentence. The buyer also assumed a $100,000 mortgage on the property. So the seller's getting debt relief of $100,000 in addition to the two payments of $200,000 each. So the seller's getting $400,000 plus debt relief of $100,000. The taxpayer's adjusted basis was $150,000. If this qualifies for installment sale, what's the total gross profit on the sale? So to get the total gross profit, we take the $400,000 contract price plus the debt relief of $100,000 equals $500,000. We call that the amount realized. And then we subtract the $150,000 basis. And that equals the seller's gross profit from the sale of $350,000, which is letter B. Okay, now that we know what the gross profit is, $350,000, the exam's going to ask next how to calculate the all-important gross profit percentage. So here we go, same facts. Year 21, taxpayer sold real property for $400,000, receiving $200,000 at the closing and $200,000 plus accrued interest at the prime rate in the next year. The buyer also assumes that $100,000 mortgage, which created debt relief, and the taxpayer's basis was the same, $150,000. If this qualifies for installment sale treatment, what is the gross profit percentage? And the first step we did already, calculate that gross profit. We took the contract price of $400,000. We added the debt relief of $100,000. We got the total amount realized, $500,000. We subtracted the basis of $150,000. So we got $350,000 for our total gross profit. Here comes the tough part. How do we determine gross profit percentage? It's usually the gross profit itself divided by the selling price. Take the $350,000 gross profit and divide by the contract price of $400,000, not the $500,000 total amount realized. And when you divide $350,000 by $400,000, you get 87.5% for the gross profit percentage. And that happens to be answer choice A. Note that the wrong answer would have been $350,000 divided by $500,000. That would have been 70%. Of course, that choice will be there, but don't pick letter C, because to get the gross profit percentage, you start with the gross profit and you divide by the contract price, which does not include the debt relief. Why? Well, by leaving out the debt relief, that makes the denominator smaller, 400,000 instead of 500,000. And that leads to a higher gross profit percentage, 87.5% instead of 70%. And this results in more taxable income, because with every collection of cash, we're going to multiply by the 87.5% to determine how much income is taxable. And because the gross profit percentage is 87.5%, each $200,000 collection will result in taxable income of $175,000, not just $140,000 as if we were to use the 70%. Why? This is because the debt relief of $100,000 is not being taxed all at once by the IRS, but instead the debt relief is simply making the gross profit percentage higher, and that's going to add to increased taxable income with every collection. So if you see this on the exam, it'll probably have selling expenses in it also. So let's do the same question again, but this time the taxpayer is going to incur $30,000 of selling expenses, and once again they're going to want to know what the gross profit percentage is, which means we're going to have to calculate the gross profit first and then divide by the right amount. And if you think you know, leave me the answer in the comments section. And don't forget to like and subscribe because it helps the channel out a lot. And if you found this video easy to follow, then you would probably benefit from the I-75 REG course as a supplement to any course that you're taking. Because at I-75 CPA Review, the right teacher makes all the difference.